Good morning, everybody. Welcome to the Flow Show, Thursday, 5th of September. A big data day awaits us and plenty of moves to talk about from yesterday. How you doing, K-Man? Still surviving?
Good morning, Ryan. Good morning, everybody. Yeah, mate, we are survivors, right? So we warriors continue to fight.
Yeah.
But yeah, we are getting into the thick of the week data-wise, and it's going to be exciting.
Yeah, going to be a big one today, and then an even bigger one tomorrow. Right, we'll kick off just by reiterating we've got our big ForexAnalytix sale going on. The lowest prices we've ever had, I believe, speaking to Blake and the others. So never a better time to get stuck into the chat room, taking in a good deal there. Even if you haven't been with us before, been thinking about giving us a go, well, now's your time to do it. Get in, get more analysis than you'll get on these webinars, because we're in there talking, trading, planning all day long. So give it a go. If you've been thinking about it, not too sure, well, now's your time to do it. Right, moving on from that, we've had a PBOC official out this morning saying he still sees some effects of earlier RRR cuts, and there's still space for further RRR cuts considering the average level. So not ruling out a reserve requirement ratio cut. Just for those who don't know what this one is, the reserve requirement ratio is the amount of cash banks need to keep secure on their balance sheets against any adverse moves. So they have to keep it in reserve. And if they want to ease policy, the PBOC, if they want to put that money back into the economy, they lower the rate of those reserves. And that means that cash can then get moved into other things. That's why it's such an important rate to keep an eye on amid all the other little rates like the MLFs and the LPRs and whatnot. So more room to roam for that. I'm getting the feeling, Kay, just talking about dollar China. I mean, we're continuing to see the one strengthen, which is more to do with the dollar weakening. I'm wondering if once and I think this might also play into the carry trade as well with the yen. I'm thinking once this dollar phase is over or the carry trades are all washed out, I think it might become a bit of a buying opportunity in dollar China if their economy is still weakening and they're looking to ease, because certainly these moves are going against the China fundamentals at the moment.
Yeah, I'm I'm just watching it every day. To be honest, I nearly pressed the button quite a bit higher, up in the 712s to start buying it again, and then I held back. I'm thinking as well. And the decent thing about it is that I'm not going to say it's going to be a massive support down there, but we could expect that once this phase is set in motion, unless US goes into deep recession or so, we may be a bit protected by everything that may be going on if we reach 7, the big figure. But I think it's potentially one to keep an eye on. I tend to agree on that one, because they are nowhere near tightening the leash on any of their policies, and also geopolitics should keep them back from doing anything stupid in regards to monetary policy. Also, they are in expansion, so yeah, I tend to agree, mate. I'm actually secretly hoping that we get an extra dollar sell-off and get us close to 7 to really have a clear view about what's going on, because I don't think investors are very keen on owning Chinese yuan just as yet.
Yeah,
a lot needs to change for that.
Yeah, and there's a potential bun fight to come if Trump gets in as well. If he starts railing against China too. But yeah, I was in a similar boat. I was looking at this 709s, 10s, 11 area, of support for maybe getting in as well, but I just don't feel it's the right time yet.
That's the question. Do you want to be ahead of the well, ahead of the crowd is a big word, but do we want to be ahead of this potentially last or not last, but next move lower, because the market is still really wanting to press the button on a lower dollar in global markets, taking away a few, of course, but and it's also a mini dollar yen, as I was already mentioning a couple of times. When dollar yen goes down, dollar China tends to go down these days as well, and vice versa. So yeah, sooner or later it should decouple, right?
Yeah, I think so. And who knows, if we get a real mess up in the data, particularly NFP tomorrow, we might be down near those low sevens. So yeah, we will have our fishing rods ready, no doubt. But anyway, moving on from that, Japan saw some good news in wages as well. July numbers coming out, overall wage income up 3.6%, beating expectations of 3%, a bit lower than last month, 4.5%, but still another solid gain. So that's good as well. Overtime pay looking a little bit more ropey, but that's not one to really lay your hat on. But pay growth still looking good over there, and that's something that was brought up by one of the BOJ members, Takata, saying that Japan's economy is recovering moderately, although some weak signs are seen. Stock FX markets have seen big volatility, but we still see the achievement of our inflation target in sight. We must be vigilant to the chance of a renewed wave of price hikes while taking into account the impact of the rise in the yen in early August. The fallout from market turbulence in early August remains, so we must scrutinise the impact for the time being. We must adjust monetary conditions by another gear if we can confirm that firms will continue to increase investment, wages and prices. He says, based on our hearings, we expect there to be more price hikes in October, though that was when the yen was weakening. So that when they heard those things about more price hikes, that was when yen was weakening. We have seen some change in FX and market moves, so must need to take a fresh look at the impact on the economy and prices. So this is really the other side of the coin. Okay, when the yen strengthens, it has the opposite effect of what was going on before. So they, as much as they need to act on the yen weakening, they have to see the impacts of it strengthening as well. If things were pretty stable and steady, then they would have a better idea of what they want to do with policy. But because the yen strengthening can have opposite effects on inflation and everything else, they have to take that into account when deciding monetary policy and whether to hike. So, Kay, do you think there's been a material difference, these market moves?
Well, according to Takata, there has been. That's for sure. It was a very interesting comment, especially, there's two things in there. Is that the yen has an effect, and we've spoken about that with the weaker yen. Their window was wide open to start normalizing, and then we see the impact of the yen to the other side now. And then secondly, the fact is that he said that if the markets would have been calm or the yen remaining weak, that they would have gone already in October again, where the market is sort of expecting them to not go before year end or even the start of next year. So there's a bit of a double-edged sword, I'd say, in those comments. Underlying trend is that they're still going to continue to normalize. But if the yen strengthens too fast, it's going to slow them down. That's the message, right? But their main thing, and we had encouraging numbers there, is those wages. So we had a bit of a two-way move in the yen. The market got a little, it's not really worried too much, but perhaps a bit annoyed with that comment saying that now the yen is strengthening or the markets have been erratic, that it will slow them down. But the overall message is still for a gradual tightening of the leash, right?
Yeah, I agree with that. Derej, you're getting in on the old short CAD yen. Let us know why you're doing that one, mate. Was that a bit of a BOC play, Bank of Canada play, as well as the yen? Let us know what your thoughts on that, and we'll look at that one in a little bit. Over at the RBA, Governor Bullock has still got a head in the sand regarding rate cuts, as it's premature to be thinking about cuts. As of now, the board does not expect to be in a position to cut rates in the near term. If circumstances change, the board will respond accordingly. Moving over to Germany, we had a little bit of data out, factory orders, and another half decent print. We had got a decent one last month, and that got revised higher. We've got a decent one this month, up 2.9%, was expected to fall back, minus 1.6%. So factory orders have shown an improvement. Mind you, it's not doesn't take much to improve when you're laying on the ground. So, you know, these numbers do look good, but comparable to where things are, we should need a lot more to get the German economy turning around. Over at the Bank of Canada, let's get into that mob. So a bit of a damp squib in the end. They cut their rate 25 pips as expected. As far as whether they were going to pause or continue, they said that if inflation continues to ease broadly in line with our July forecast, it is reasonable to expect further rate cuts. Said we don't expect, or Macklem speaking, said we don't expect a bigger rate divergence with the Fed. We have not reached any limits in that divergence. And with the Fed expected to cut, we don't expect the divergence to come into play. Macklem's also talking about the FX moves as well. I've not seen a big divergence there. Speaking on their policy decision, they said there was a strong consensus for a 25 pip hike. And then he went on to put everything on the table as well. Yes, mate?
Cut.
Sorry, cut. Cut. Okay. I'm just about to say they put everything on the table, not quite that. They said they discussed different scenarios, including the slowing the pace of cuts, and also discussed a 50 basis point cut. He said in one scenario, if the economy were weaker than expected, it would be appropriate for a cut larger than 25 pips. We need to see Canada growth above 2% and have factored the need for more growth into the policy decision. So he has, or they have, listed certain conditions where they would continue to cut or even do a bigger cut. So if growth falls off a cliff, then expect a big one. But as I said, they discussed slowing the pace of cuts and a 50 pip cut. So they're putting it all on the table there, not to be boxed in anywhere. Your thoughts on Macklem? I mean, the Looney did naff all yesterday, did it really?
Exactly. I mean, it even strengthened somewhat. All as expected, I would say. No big changes from or by Macklem. Rogers wasn't fighting too much against anything either. Okay, they did mention a bit of a two-way interest. It just seems like positioning, perhaps already the market expecting too much of a dovish picture out of there. What I would add though is that there's been one of the Trudeau's in the party there who turned his back to Trudeau. I don't know, the overall picture in Canada still seems not overly positive, but yeah, I think sell the rumor and don't do anything on the fact anymore. We do sometimes have those kind of reactions where once the market gets what it wants, it steps out of positions also. But yeah, I don't see too much fundamentals right now to buy Canadian dollar. As a matter of fact, I'm like very small, but it's like really a tryout long sterling cat, which is which actually gone down a bit yesterday as well, and then came back to where I'm long this morning. And but yeah, Canadian dollar. Probably the market already looking forward to what's going to happen in the US today. And then because the crosses haven't really moved an awful lot after the Bank of Canada. So I think let's wait for, oh, we have Canadian unemployment tomorrow as well, right? We have a
Yeah,
double,
double whammy.
double whammy or double trouble tomorrow. So I think the markets will already be focused on that one.
Yeah, very much. And yeah, I think it moved. Well, there was little move in the CAD, as you say, and I think we quickly switched to the dollar side of things, back to the Fed. With yields dropping, that's why dollar CAD moved a touch lower to test 135. Derez, looking at your CAD yen, I think you're playing this one pretty much the same as every other yen pair at the moment. We didn't see much influence from the BOC yesterday, so I think you've got to really look at this from the yen side, personally, more than the CAD side. But if their economy falls off a cliff or turns really nasty, or we get a stinky jobs report tomorrow, then it's going to be a double wind for this one, CAD yen. So if you're short, I don't know where you're short, mate. Hopefully above where we are now, so you've got a bit of margin in it. And if you are, well done, and sit on it for all it's worth, mate, and see where it goes. Sit on a trade. You know my thoughts. If you're in a good position, if you're on side, try and ride it as far as you can. Right, moving on to the US side of things, we got a little bit of fun and games from the JOLTS data yesterday coming in. Let's see if I can find it. Where am I? Yesterday. Where are we? There it is there. JOLTS. So coming in well below 8 million at 7.673 million. That's adding to all the jobs bears in the market at the moment. Openings falling suggests that people aren't looking to hire workers. We're still not in a situation where we're seeing wholesale job cuts, although that was something that cropped up in the PMIs. But that job's opening again, giving yields a knockdown, giving the dollar a little knock on the head as well. Factory orders, they were out okay, came in above expectations, 5%, beating the 4.7 expected, reversing the minus 3.3 last month. Even if you strip out some of the big ticket stuff like transportation, they came in above at +4. The revisions for durable goods largely unchanged for that. So again, it highlights, I think, Kay, that there's parts of the economy, or the underlying economy, is still doing okay, and everyone's just worried about the jobs market.
Yeah, that's it. And we are seeing now, because and I've been saying that quite often the past months, actually, focus on the jobs market, but we have to acknowledge that the rest of indicators are not really falling out of bed, right? So I think it's also important to note. And obviously, we have to look at everything jobs related, because Powell just told us that that's their focus right now, because they're relatively happy with the direction and perhaps the speed, or and knowing that it might be bumpy on the inflation side of things, but they just told us, and everybody is telling us that we have to watch it. All the rest of the speakers as well are now our Fed speakers are now aligned too. But yeah, we have to acknowledge that the rest of the economy is not really doing too badly, I would say. So and that's perhaps looking a little forward to what may happen today if the ISM doesn't paint too bad a picture. People may have to just readjust the positions perhaps a little going into tomorrow's mess.
Yeah, I expect we're going to see plenty of that coming into tomorrow, most definitely. Now, after all that data, and particularly the JOLTS numbers, short-term US rate futures priced a 50 pip cut over a 25 pip cut. So we're still playing that pendulum game where we're seeing the market swinging around these data points in terms of how big a cut is expected. And as we've been saying for a couple of weeks now, if not longer, that's the game we're playing. It's not whether they cut, it's how much they cut by. If we look at Fed fund futures on the CME, you can see that the 25 pip cut is still the favoured choice here. So again, this swings around by the data. So there's lots of different metrics you can look at to gauge rate expectations. This one you can grab. It's free. You can look at it. You can keep it, bookmark it, whatever, just to give you an idea of how the market's swinging around. And when you see some of those extreme moves, if a 50 becomes more evident than a 25, you'll see that in the pricing as well when the market. Now, I have to say, and I said this in our chat room, I'm getting a little bit twitchy about a 50. My base case is they only go 25 because there's not enough evidence to suggest they need to go a 50. But I'm getting a bit twitchy because if they are really, really concerned about the jobs market, they may be in a position where they start to feel they're a bit behind the curve. If we get a real stinky one on Friday, then yeah, I think the odds may increase for a 50 pip cut. But it's just something that's playing on my mind. I'm a little bit more inclined to lean towards that way than I was previously. It's probably a 5-10% chance in my own head, but that was 0 a few weeks ago. But yeah, it's creeping into my mind, so I'm never going to rule anything out, and I might rule it out even less depending on the data. Meanwhile, Fed Bostic says we must not maintain a restrictive policy for too long. Soft economic landing may be within reach. It says most recent inflation reports have bolstered confidence that inflation is likely on a sustainable path back to 2%. He says among his business contacts, there's no panic, but they describe an economy and labour market that is losing momentum. He also says his contacts point to a loosening, but still broadly stable labour market, which is again is important. Quite a few Fed heads are saying the same lines. Fed's daily is a little bit more on the fence. Says the Fed needs to cut policy rate because inflation is falling and the economy is slowing. The size of a September Fed rate cut, we don't know yet. She needs more data, including Friday's jobs market report and CPI. Says the labour market has softened, but is still heavy, and that has to be sustained and protected. It's hard to find evidence that the labour market is faltering. We're not getting a recession apparently because the old inversion metric 2s 10s have uninverted. So all that usual waffle about how inversions lead to recessions, blah blah blah, bollocks, is all up in smoke again. Doesn't mean we can't get a recession, of course, but I won't go into the details of why inversion forecasting recessions is a load of old crap, mainly because the reason you get an inversion is because something's going on in the economy anyway. But moving on, I'll have that rant another day. The Fed's Beige Book, which is a regional bank report of all the Fed districts, running economic report, if you like. The latest one said economic activity grew slightly in 3 districts, while a number of districts reported flat or declining activity rose from 5 to 9. The report said that employment levels were steady overall. Reports of layoffs remained rare. On balance, on prices, they increased modestly in the most recent reporting period. So again, no signs of big weakness in jobs markets, and indeed still some price pressures there, but noting that the economy was stalling a bit and only growing slightly in several districts. So we are seeing a bit of flatlining coming into the US. The banks are getting twitchy. UK banks are getting twitchy ahead of the new Chancellor Reeves' budget. Apparently they're going to meet the Chancellor to discuss concerns over a possible increase in bank taxes. Shock horror. As Kay mentioned, there's been a bit of political upheaval in Canada as well. The NDP, a minor party, the NDP party, announcing it will end its coalition agreement or governance agreement with Trudeau's Liberals. That they've had this small agreement, which has pretty much kept Trudeau, the main party or the government, in play. I don't understand the full ins and outs of it. It's a confidence vote thing. So every time they need a vote of confidence on something, that's where they get backed by this NDP party. But they're now saying that they're going to end that partnership. Trudeau says he hopes the next election will not happen until next autumn. But as I say, I don't know the ins and outs of that one. We could be heading for election or mess or not. No idea. But another political mess to keep an eye on. And lastly, OPEC seemingly decide to come out and give oil a shot in the arm every time it gets down towards its recent lows. Two headlines yesterday. Two headlines coming pretty close to when we made these lows, saying that they are discussing a delay to a planned output hike in October. We got the first headline saying they were looking at output hikes a few days ago, increase in production, and now they're talking about delaying that after seeing the price obviously tumble. We got two spikes on that headline, one there and one there. So the same headline brought a bit of a spike, but we've since come back down again to lows. But it's creeping. Kay, anything else for anything else?
We have covered everything, Ryan. The one thing that had me not surprised, because they've all changed, as I said, over to Labourist Dali. Used to be a bit more hawkish, and they all seem to be softening their stance right now, and it's a global thing, right? At the Fed, it all seemed quite well orchestrated, if you ask me, that they all change their opinions and leaving the door open now. Which was interesting in there as well, is that she said that the size of the cut will be determined by the jobs report tomorrow. So they're really sending us to like themselves pumping up this tomorrow's jobs report. So it's going to be spectacular, I think. But no, we've covered all the rest.
Yeah, I think that one comment from Daly as well, saying the size of a set Fed cut. They're not even looking at not cutting. It's a done deal. It's very rare that you get a central bank not at least keeping that optionality, saying it's likely, but coming out and talking about we will be cutting in September is a pretty strong signal in itself.
That's the shift we have seen now over the past, let's say, weeks or over the past monetary policy report. That's clearly the shift we've seen. So that's where we are at now. And actually, talking about the sizes also perhaps already a bit telling. And I'm like you. My base case is for 25 BPs, but I'll reserve my final thought on tomorrow's jobs report. Whether we go for a 50 or not. It could well be, if it's really a rotten report tomorrow. One really last thing is that yesterday, did we speak about it yesterday on the MEX, that they haven't voted yet in Parliament, but it's already been accepted that there will be a vote on this judicial system change in Mexico, and that obviously, after a bit of a F.A.C.E move yesterday to the other side, may have been just because we were Wednesday and people didn't want to pay for the weekend funding, but the MEX is again suffering on the back of it, and that is something that investors really don't like. So watch out if you're don't just jump in the carry trade yet. I would say, if I have an advice to give, wait, reserve your keep that ammunition in the locker for now.
Yeah, yeah, and there's been tons of protests over there about it as well. So
Yeah.
it's been kicking off over there. So not many happy bunnies over there.
No, I wouldn't be surprised if we revisit those highs here we saw earlier.
Yeah, Marcus. Yeah, I saw that big crude API number there. The funny thing is, it's the API is a bit like ADP for employment. You know, that one can come in with a big minus 7.4 million, and then the EIA data can go the other way. So, yeah, you get big swings in it. You know, we saw that in US oil, further dip, which got down to its support actually. Might as well look at it while I'm on here. So we're getting into a bit of a support area down here. Down in the 66s, 67, 68s. So if oil's going to bounce anywhere, this is the type of area to look for it. I'm still got some bids in Brent down at this. It's a bit more cleaner down here against this 71, 72 area. So I'm looking to trade Brent off of that. Give it a little tech play. Won't be giving it much room. Bit below 69s. I'll be looking to get out, so that's where my stops will be parked. But if it's going to bounce anywhere, that's where I'm pegging it to give it a go anyway. Right, the rest. A bit of treading water. We have seen Euro picking up a bit. It's up testing the 111 zone. We had this little bit of a fake out yesterday or Tuesday, tried to get below that support around 110.40s and the fib there. Didn't last, got back above, held it as support straight afterwards. Now we've had a move back above this 70s area. We've got the first move up and then a little bit of wishy-washiness, but now it's holding that 70s area now. We're trying to find a way through 111. If we get through there, I think we probably need to see it confirming a breakthrough here. And then we're going to be looking at 111.30s, 111.50s before thinking about a move back towards that 112. Again, though, you can't trust a move longer than 5 minutes. And if our mate DK's watching, he loves talking about trusting moves, because if we get strong numbers today from the US, then we're heading all the way back down again. So again, you know, you can't really think, oh, this is good level, I'm going to short it here ahead of all that data. Because if the data is weak, then we're probably heading back up towards 111.50. So it's a difficult time to still a difficult time to trade. I'm still short. My stop's up above this area here. No, it's actually a bit lower than that. I brought it down 111.25, so I don't want to give it much room above the big figure if it does break. So I'm still short this one, but I could be knocked out today, or I could be looking at a few more profits if we get back below these levels down here. But still, you can't really have a lot of conviction at the moment. Looking at dollar yen, just quickly, I'm going to look at the wider chart because I'm keeping this in the back of my mind. This is an area down here I'm really keeping a close eye on. These fibs, this confluence down here, natural levels already, historical levels already. So if we get a move back down here, this again could be maybe a bit of a last hurrah move once we seal the deal from the NFP or whatever over what the Fed's doing. So that's my big support area. We are creeping down. We're following yields. So that, as we've been saying again this week, you need to keep an eye on yields 2 years breaking down below that area 385s, heading back towards that NFP low from last month. And if we get a bad number tomorrow from the NFP, if we get some bad data today from the ISM and whatnot, we could be heading back down there and the dollar going with it as well. So keep an eye on that. 350, around that 350 area is going to be the next level for yields down there. So know which one to follow when you're looking at correlations and whatnot. Likely the dollar is going to follow yields on this one. I know K's in gold, but I'm keeping an eye on this one as well. Yeah, it held that support, give or take, and a little bit of a
very well
lunge underneath.
Very nice hold.
Yeah, nice hold. Let's see if it doesn't. You can probably stick another line in now at 70s. There's a secondary area now. Support was 80s. it had a bit of 70s in it, so call it 70-80 now. I guess we get to see what happens at the top. The one thing I've noticed with this, obviously we're getting a big move in yen. We are getting big moves over the data, but gold isn't moving that much, is it? And I'm still a bit reluctant that we've not, if we come out a bit further, we've not really had, it just seems to be running into a bit of slowness now. It's taking longer to grind higher, but it's still going, mate. It's still going higher.
Yeah, I think it's as I said, I mean globally it's still looking big. Yeah, we have been building on that 70s, 80s support now, which was resistance before. Had a couple of looks below. First time was likely a stop run, but now it's a retest and it bounces again. It's really nice. You know what? I think ISM today has the potential to be a bigger mover for it than tomorrow's jobs report. And I know that tomorrow everybody is watching the jobs report, and so are we. But ISM could be a mover, for stuff like this. And so it's going to be interesting, especially if it drives it back above that 25, 30, 35, then it may get a little explosive, I think. But so far, yeah, as the people in the room know, I've bought it in the 80s, sold already a little out. I'm always managing the positions like this, and now I'm waiting to see what's going to happen. Well, I mean, it's going to be an easy, let's say, relatively easy cut. If it goes down back below 67, 70 or so, downside, it's no use to be long because then we're probably going to correct lower. But in the meantime, yeah, don't change a winning team. That's it.
Yeah, I mean, I would be potentially eyeing a break trade. I'm not in anything at the moment, but if I was going to get in it, I'd look for a break trade of those highs. But I would like it to come after all the NFP stuff's done. If you get a break after we're over all that sort of stuff, day after, 2 days after, that would be a more solid break, I think, rather than a risky, fake move over a data point or something. Yeah. So, yeah, that's my plan. If we don't break it over all this data, but break it after, then I might go with a break trade on that one. And
yeah, and as Angela and Gavin say, I mean, it's 2,500 pivotal. Yeah, you got $30 above and $30 below to play with, right? So rangy, as Gavin says, and yeah, so we went for a few stops out of the 24, 90, 25, 30 zone, and now we're bouncing again. Yeah, it's going to be a dollar trade over the next couple of sessions, and then we'll see where we land tomorrow after the data.
Yeah, very much. And stocks is another one as well. I was getting a little bit twitchy to have a little go yesterday against this 55. I remember saying it to Dale on the F.A.C.E show yesterday. It might be worth having a little go here. I didn't bother. I just haven't got the conviction, and it got a decent spike up to the 50s, up to this broken point up here. We're back down again. We're still hovering, so I'm probably going to sit on my hands again. I still like this 54.5 area, 54.40s area for a pullback. So maybe that's where I'll give it a go if we do see a dip there. But I'm not getting stuck into the as soon as you get a bit of a dip, it's the end of the world and we're going all the way back down to 4,000 or something stupid. You got to trade this one on the levels, and we get some decent levels here. And there's still nothing breaking in the US, despite some weaker data. There's still nothing falling off a cliff, and you've got to keep that in the back of your mind. So, yeah, I still think dips are the way forward in this one, but let's get this crap data out of the way and then see what the picture's like a bit clearer. I'm not going to touch Euro Sterling. I don't know if Ali's about today, but that's doing absolutely nothing. Again,
worth noting though that 35 trades a lot in Euro Sterling and it comes back off it all the time, but it doesn't shy away from it as much anymore. But there's definitely stuff going on around that 35. I still think somebody's trading around an option also there, and like sell 35, buy back at 25, and it looks like we're getting closer to some non-reported on whatever those reports are that we find online. Also, some non-reported option. It looks as if there's something going on around that 84.35 because it keeps getting traded.
Yeah, well, it's one of those weird numbers. I mean, look, we had it going back in June. We were trading around there as support. Then it was resistance and support and resistance. I don't know what it is about that level. You get these levels sometimes, whether it's option or whatever. You get some funny numbers. That's the way it is. You stick a
Because
line
you
there and
avoid the
keep an eye
round
on it.
numbers.
What?
People avoid round numbers now. They've understood that if you put a strike at 84 the figure and you stop at 84.01, I mean you're going to be feeling a bit stupid, right? So they rather put like odd numbers.
Yeah. Yeah, no, I agree with that. It still seems quite high. I usually get 2025s or something like that. But why it's 30, 35 in this one?
I don't know, man.
Who knows?
Is
Who
it
knows? I
something you've
remember.
added, perhaps?
Yeah, I remember. What was it? 77.40 in Aussie dollar. I remember that time a couple of years ago where we got options day after day after day after day. 77 was it 77.40 50? I think it was, and we flagged that up. That the price just stayed around there. Well, that was a few years ago, anyway. Strange the things that stick in your mind. Right, Kate, over to you, mate, before I start rambling.
Yeah, I'm not going to take too much time, but I see there Charles asking why the rand has been strong of late. There's been a couple of things coming out, but which was relatively okay for the rand. First of all, there's been I think it was 150 or 155 days without any power cuts over there. So Eskom um, trying to fulfill the election promises. Also, they went into a period of relative calm, and then you of course had the dollar coming off in all of this. But I think Charles, I'm not saying that it's all over done and dusted, but if you look a bit at the geopolitics, I've also read a couple of articles saying that the honeymoon with the new government may soon come to an end. And Eskom, Transnet, we've seen Transnet had to take a loan, and their pretty deep involvement with all things China make me think that perhaps, unless we get a big drop in the dollar, but maybe somebody wants to look at a different currency versus the rand, but we may slowly come to an end of that honeymoon. And and the second thing is that on the data front, actually, we had a few PMIs coming in slightly better than expected. So that's kept the rand from really dumping. And then the last thing, perhaps technically, we have been banging our head every time we try to rally above 18. It's been rejected right now. But yeah, that's about why it was so strong. But I'm starting to look at it really because the dollar is still on the weak foot, obviously. But perhaps I'm going to look against some other currency or so. To eliminate the dollar side to see if there isn't anything to do, because I'm not a real rand believer myself, so that's it. In dollar wise, I'm going to be watching those US numbers. If I see a drop back down to 1760 and it starts to hold, perhaps I'm going to give it a try and then watch this low here for perhaps putting a stop below there also. But I'm starting to be tempted, just timing wise as well. That is it. I was going to look at gold, but actually Ryan already showed everything. Silver in sympathy, coming back a little, but I think it's all a lot less obvious what's happening in silver. The big level is still going to be around 30s, but I will get interested if on stronger US numbers, we would get a move back into this 26.5, 27 zone. I'm going to really get interested for my long term, perhaps starting to add a few to the long term position again. Yeah, gold is 24.30. Well, 25.30, sorry. I am sort of done. Just one last one. If you look at yesterday, and this is for ones I'm looking at the short term, this is the correction in cable that we've seen. I think globally still beat for as long as we stay above this 130.20, 130.90 zone. That's my more medium-term feeling right now. But look, the 50% level is capping it 131.75 in the cable. That's going to be your gateway, I think, to back to higher levels on the numbers this afternoon. And then on the downside, keep an eye on what's happening really intraday. 131.25, 131.30, perhaps that's your tightest range, I would say, to watch. And then as I said, wider one. Anything anything from 130.90 down to 130.20-ish, I think is going to be relatively important. Okay, you get a close above 131.75, 131.80, then I think we are going for a revisit of these highs, perhaps even on the ISM if it's crappy before before tomorrow's data. You know, the market always loves to sell dollars into a jobs report. And I think that is enough for me for today, Ryan. Back over to you, mate.
Thank you very much, mate. Great stuff as always. Yeah, we'll call that a session. Thank you for coming to the Flow Show as always. Don't forget to check out our sale on the ForexAnalytix platform as well. Have a safe day's trading, and we'll pick up the pieces and what mess is left for us tomorrow morning. Thanks, everybody.